Today we look at our final two investment strategies in deciding which one is right for you. So the first one we're getting into is quality investing. Now, quality investing is an investment strategy that focuses on high quality companies, strong fundamentals, and a track record that is very consistent with growth. When you think of the S&P 500, a majority of the companies on that list do meet that criteria and have been on there for a significant amount of time. Quality investors prioritize companies with sustainable competitive advantages, strong management teams, and a focus on long-term growth rather than the short-term gains. So there are really 5 criteria that you're looking at when you're looking at quality investing. Number 1 being the marketing positioning. Quality investing emphasizes companies with a strong market position, indicative of the competitive advantage. When you look at Apple, when you look at Nvidia, when you look at a couple companies like that, they have a very strong competitive advantage and a lot of brand recognition. High market share and price power. Investors look for firms with unique products and services, a very loyal customer base such as Nike, Adidas, things of that nature, and a great brand presence. Number 2, looking at their business model. This outlines how the company creates, delivers, captures value within a market. Quality investors seek companies with scalable and sustainable business models. Number 3 is the corporate governance. Corporate governance refers to the rules and practices governing the company's direction and control. Everybody wants to be a part of a company that is fundamentally sound, but you also want to make sure that the morals are there, or the company is going to have a lot of issues within it. Quality investing stresses strong governance to ensure oversight, transparency, and accountability to the company. Investors value companies with independence and competent boards, ethical practices, and a commitment to the shareholders' right. Number 4, we look at the financial strength. This is probably one of the absolute most important ones. Financial strength evaluates a company's ability to generate cash flow, maintain a healthy balance sheet, and withstand economic challenges. Quality investors examine key financial metrics like revenue growth, profitability, debt levels, and liquidity. The final one is the evaluation. Attractive valuation assesses whether a company's stock price reflects its intrinsic value. Quality investing considers companies trading at a reasonable or undervalued price to earn and get growth potential. Now, some of the advantages to this investment strategy, focusing on the quality investing focuses on high quality companies. Like what we talked about, this one does have a long-term mindset. Quality investing is a long-term strategy that encourages investors to focus on a company's fundamentals and potential for long-term growth rather than the short-term fluctuation. Now, also with this strategy, potential for dividend income. Most of the well-established larger companies do pay out a regular dividend. High-quality companies with a consistent track record of earnings may be more likely to pay out dividends, which can provide a steady stream of income for investors. We talked about dividend income a couple of videos ago, but absolutely something that I love to look into. Now, disadvantages: limited growth potential. Well-established companies might be to the point where they've grown to kind of their maximum market or the essentially customer base or consumer base that they have, but they really want to prioritize a high growth potential. Now, quality investing may miss out on emerging industries or innovative companies and do not have a track record at this time. And it may be difficult to identify some high quality companies. You got to make sure, guys, strong fundamentals, a good track record of consistent earnings and growth, even during difficult times, which is huge. Now, the last investing strategy we get into is my favorite. Personally, the dividend investing and the index investing are my two favorites, guys. Index investing is a passive investment strategy that typically uses exchange traded funds. That is right. It is my ETFs. We're going right back there, guys. Or mutual funds to gain broad market exposure to the market, such as the S&P 500 or the Dow Jones Industrial Average. Rather than attempting to beat the market through active stock picking, investors seek to match the performance of the market as a whole by investing in a dividend stock diversified portfolio, which I love, guys. Now, the big thing with this, when you look at some of the greats like Warren Buffett says everybody should own the S&P 500 and pieces or a majority of the S&P 500. Very few financial advisors, which I am not, almost 90% of financial advisors cannot beat the returns of the S&P 500, which is absolutely crazy because one, the VVO, the Vanguard S&P 500, has an incredibly low cost. Most financial advisors are about 1%. The VVO is a 0.03, which is again a big reason why I invested. Now, in addition, guys, there are a lot of advantages to investing into this type of portfolio with the index investing, including the diversification is the biggest one, guys. Index investors offer a broad market exposure and diversification as investors gain exposure to a wide range of stocks across multiple sectors. Potential consistent performers. That is really one of the big things, guys. Index funds usually have and offer consistent performances over a long term. As they invest, the average performance of the market as a whole trends to be upward and downward. They are more consistent. And then it is the passive investing, which is exactly what I'm looking for. Investors do not have to consistently manage their portfolio. As the S&P grows and expands, it is actively managed, and it will change the investments that are in that VOO fund. Now, disadvantages: limited upside potential, which again, this is more based on the long-term growth, which is what we're looking for. Index investors are limited to the performance of the market as a whole. They may miss out on opportunities of individual stocks, which again, I do not personally want to invest in. Individual stocks, you'd have to watch it a lot more, what's going on with companies. Little opportunity for active manage. If an investor chooses to focus only on index funds, they may miss an opportunity in active management. Index funds need to be combined with other investment strategies, which I do have. So I do have the index fund strategy, I have the dividend strategy, and I also do have a portion into REITs and cryptocurrency. So there is kind of a break between all of them within the strategy that I'm using. Now, the exposure to market fluctuation is the last disadvantage. Investing in the market index such as the S&P 500, investors can be cautious, but can look at market fluctuations in downturn, which could result in temporary losses, which is the reason why I couple this with DCA, with dollar cost averaging into the S&P 500. That way, even again, looking at 2022 as a prime example, as the S&P 500 continued on that downward slope and we seen the decline, I was purchasing it the entire time throughout the whole year, every 2 weeks, passively putting $1,000 in there to go ahead and buy that again and again and again. Now, overall, guys, I hope this really helped with the investment strategies, trying to figure out which one is for you. Now, a lot of them have their own advantages and their disadvantages. You need to see and let me know in the comments which one you think is the best for you. Dividend investing offers the potential for constant income streams. Dollar cost averages reduce, of course, the impact fluctuations. Value investing emphasizes buying undervalued stocks, while growth investing is the high growth potential stocks. Quality investing focuses on prioritizing investing in companies, strong financials, and a competitive advantage, while the index offers a broad market exposure and diversification. So really cool to see and break this down, guys. This is an article that was actually over on M1 Finance, which again, I do use for all of my investing. That'll do it for today's video. Let me know in the comments what you guys think, and as always, thank you guys for watching.